The deals today are priced for 2026 and beyond. Most investors are making a mistake. They're structuring their deals for 2025 even now. We're in December. So in this video, I'll show you how to structure the deals right now so they are profitable in 2026, including what makes the market, what the market is telling us for the next year, and how you position accordingly. So from our previous videos, you know exactly how to find a property, how to refurb it. Now it's about time. I'll show you how you structure the deal, and so you can profit regardless of what the market does in 2026. So okay, 2026 is coming up fast now, guys. We're in December and the fundamentals of property are shifting. Okay, if you don't set up the deal properly this year now, you'll feel it later on. So this blueprint from me is for profitable deals in 2026. So okay, what's the market saying in 2026? All right, the analytics expect a modest growth next year in UK house prices. Many forecasters are forecasting it to be around 2 to 4% growth across the UK. So, and regionally, the North, the Midlands, parts of Wales, Scotland are expected to outperform London, which has been a case for some time now, and the Southeast may lag behind as well. Okay, so the key drivers: undersupplying of housing stocks, we all know that the government is actually struggling. Easing interest rate pressure, rental demand staying strong. Okay, these are going to be the key drivers. If this happens, then things will move forward positively. Okay, but caution. Okay, affordability remains stretched, which is supply remains high in some regions, and the policy and the tax risks are still there. As you know, new governments bring in around every year, they bring in new rules, new regulations for landlords, for property developers, which is making the business harder and harder, and it's hard for people to keep up with that. Okay, so the implications of this is that the deals need to be structured assuming modest upside, not the boom. There's not going to be a boom. Okay, and you must build margin and resilience in your deals now. So if you build it now, so you're ready for 2026. So here's my 2026 deal structure checklist, guys. First of all, number one, purchase price buffer. So make sure when you're buying, you buy at least 10 to 20% below market value. So what that does is that gives you a margin even if the market slows down. So the second one on the checklist is refurb and value uplift plan. So make sure you got a clear uplift plan where you're trying to target to add value for profit. Okay, and make sure your refurb is aligned with the needs, the value what's needed in 2026. What I mean by that is, for example, you need energy efficiency, you need flexible layouts, and HMO friendly atmosphere. So when you do start these refurbs, make sure you got a clear exit strategy. For example, will you flip, will you refinance, or are you going to hold for cash flow? But in 2026, what I'll be doing is I'll be leaning more towards hold and refinance, and obviously HMO for a good cash flow rather than all these fancy speculative flips that there's going to be big price rises. So don't go for that in 2026. I would say hold and wait and just enjoy the cash flow. So number 4 will be your finance and recycle path. Make sure whatever structure you use, whatever finance you use, it is actually structured so you're trying to recycle your money, and obviously build in contingency and other fees in there as well. Number 5 is going to be the rental market alignment. So with the sales growth is going to be modest, so then rental demand will drive the value really of any property. So focus on locations with strong rental market, and where there's a demand for more HMOs, trying to target those areas. For example, close to universities, close to big airports, retail parks, city centers. So with good train, tram links, try and target those areas. So number 6, regulatory and tax sensitivity. Make sure you compute for worst case scenario, because we are living in an unpredictable market. Okay, so tax legislation changes, so make sure you compute for all that worst case. So for example, buy to let tax, licensing and EPC standards, the government could change anytime. Remember, they were saying the EPC standard is going to be at least C, and then they've waited for that, they have delayed it, so that could come in anytime. All right, so structure the deals so that in a way that you're still profitable even the regulation tightens. So I'm going to give you an example what I'll do, how I'll structure a deal which is actually ready for 2026. So okay, 2026 in mind, say you buy a property for £160,000, target for 20% under the comparable at that time, and then say your refurb budget, you're going to refurb the property for 30k, and you're targeting the GDV, which after works is going to be around 230,000. Okay, finance you need to arrange for that is obviously bridging for purchase, and then exit's got to be buy to let mortgage. All right, so after that, the rental strategy, trying to convert into a minimum 4-bed HMO and trying to target the area where you can get a rent of around £2,400 per calendar month, trying to target that area. So you got the built-in buffer now. Okay, now let's say the worst case scenario, the GDV, the growth is not there in 2026, so GDV comes down only at 215,000. You were expecting 230. Okay, but still it's giving you immediate margin even if the growth is muted. All right, so this structure means that even if the growth is only say 2 to 3%, you're still making money. You're not reliant on the boom. So that's how you need to structure your deals. This is just an example how you can actually buffer yourself against slow market increase, okay, in the prices of the houses. So guys, where to look for deals in 2026? Okay, I would look for deals in the northwest, northeast, Midlands, and towards Wales. Okay, because you got to look for areas where there's strong rental demand and the affordability is pretty relative. Okay, property types, what types of properties we'll go for? We'll go for houses rather than flats. We'll go for HMOs and multi-let conversions. So where we can add value to refurbishment, we'll go for that kind of properties. Auction and distressed stock. More supply will obviously come in, because as more owners are realizing that the growth is modest next year, maybe they want to sell, they want to get rid of their properties. So look for those opportunities. Build a pipeline early. Go and do your viewings. Get the inspections done. Get the valuations done now, so you're ready for 2026. So guys, remember, in the end, what I need to say this to you guys is that the deals in 2026 are the deals in 2026 will win, not the ones which are actually guessing for a big price jump. Those deals are not going to win in 2026. The ones which are structured properly, they're built on value, margin, and proper structure, those are the deals which are going to win. Okay, so comment below guys, let me know what's your biggest deal structuring in for 2026, and Merry Christmas to you all, Happy New Year. And yes, make sure you subscribe to the channel, because in the next video I'm gonna tell you about how to find and finance HMO conversions for cash flow, especially for 2026. So that'll be my gift for you for New Year's. So until then, keep working hard, and I'll see you in next video.